Alrighty then, as promised, chapter 18. Chapter 18, the last chapter that we're going to cover. And so we looked at commercial lending in chapter 17, and now we're going to look at consumer lending. Consumer lending, okay? So consumer debt, that's lending to individuals and families, is one of the fastest growing line items for banks, okay? And I thought this was interesting. I looked this up. There's approximately $14 trillion of consumer debt in the United States, $14 trillion, and that compares with $22 trillion that the federal government has in debt. So we talk a lot about the federal government debt of $22 trillion. You hear that in a lot of political contexts, but you don't hear nearly as much about how much consumer debt that we have out there. So I thought it was interesting to throw that out there, 14 trillion. All right. So banks dominate consumer debt, and the reason they do is they have a connection with individuals and with families, and that connection is checking and savings accounts. Okay? And that connection was even stronger back in the day when you had to go into a bank to make a deposit, and you had to take your paycheck to the bank. And so all that has changed, and so the connection with the bank is not as strong as it used to be, but there's still a lot of banking that goes on between individuals and commercial banks, and so that brings people in contact with the banks, and so banks are top of mind when it comes to who am I going to borrow from. Whoops. All right. So the book makes a point of the fact that consumer credit, lending to individuals, is a very profitable operation, okay? But it can also be costly and risky. And I'm going to show you some data that kind of backs that up, why it's costly and risky, or how you can measure that it's costly or risky. So, what kind of consumer loans are being made out there? If you go into a bank, talk to a loan officer, the purpose of the loan, okay, so what someone is going to do with the loan proceeds is one way of classifying a consumer loan, and then how a loan is going to be paid back is another way of classifying a consumer loan. So will it be paid back in installments, which will be a level pay, the same payment on a regular basis, and it'll be amortized, which means that when a payment is made, part of the payment is interest and part of it is principal, okay? Or will it be a lump sum, which means there'll be simple interest charged on the loan, and we'll go over simple interest, we did that in ManFin, with a balloon payment on one date. So simple interest means there's no principal being paid along the way, and then boom, at one point in time, the bank's going to say, you need to pay all the principal off. And typically, what happens at that point is you roll the loan into a new loan. And so you don't dig into your pocket at that point to pay the loan off. You roll or renew the loan. Now, sometimes you'll sell, if you use money, loan proceeds to buy an asset, and then you sell that asset, you use the proceeds from the sale of the asset to pay off the balloon payment of the loan. Okay. So we have residential loans, okay, and this is credit that is used to purchase a home or to fund improvements on the home, a private residence, not commercial, okay? And these are usually long-term loans, typically 15 to 30 years, okay? There are shorter terms, there are 20-year terms as well, and the loan is typically secured by the property itself. Okay? And so the bank will get a mortgage lien on the property, meaning that the bank will actually get temporary ownership of the title of the property until the loan is paid off. Then it becomes yours. So you actually don't own the house, you own it with the bank. All right? And they may either carry a fixed interest rate or an adjustable interest rate, typically. And banks are by far the leading residential mortgage lenders today. Although the federal agencies own a large amount of mortgages, and you heard Darryl Welch talk about this. Okay? And then there's home equity lending. And home equity lending is when borrowers use the equity in their homes, the ownership that they have above and beyond what they owe. So equity is going to be the market value of your house versus the debt in your house. Let's see if that's on. Yeah, there it is. So equity is the difference between a home's estimated market value, what you think you could sell it for, and the amount of debt that is outstanding against it. Okay? And there are two main types of home equity loans. The traditional home equity loan, which is paid off in installments. Okay? It's an installment loan, typically with a fixed rate. Or you have an home equity line of credit, and that allows you to borrow, repay, and borrow again, and that typically will have a floating rate. So you often will have the choice if you're setting up a home equity loan, and you can use home equity loans for anything. You don't have to use a home equity loan to improve your house. You can use it to pay medical bills, you can use it to pay education costs. All right, then we have non-residential loans, and these are installment loans, and they're used to buy big ticket items like automobiles, boats, furniture, appliances, or sometimes they're used to consolidate other household debts. So any debts that you might have, you'll roll them up and you'll take out a loan from the bank. And typically, the reason you do that is you'll get a lower rate on the bank loan and you'll get a longer term to pay it. So a lower rate and a longer term means that your payment is going to be lower, and that's what you're trying to do. Give yourself a little breathing space, okay? And so they're often short to intermediate term, and they're paid either monthly or quarterly. Then you have non-installment loans. We mentioned those before, and they are repayable in a lump sum or a balloon payment, okay? And then there is the credit card loans and revolving credit at a bank. And so banks, you might have a Visa or you might have a MasterCard, and that is a brand name, okay? But the banks issue these credit cards, so it's a partnership really between Visa and MasterCard and the banks and the retailers, restaurants, and retail stores that actually accept the cards, okay? So they all partner together, and they all have their hands in your pocket, and so the banks are the ones that actually provide the financing. So a credit card is actually a loan. So credit cards will offer either installment loans or non-installment credit, which is charge cards, where you pay it off every month. Okay, so you have an outstanding balance, and about 2/3 of all credit cards actually have variable rates of interest on them. So you have to be very, very careful when you take out a loan with a credit card. When you're using your credit card, you need to be mindful, and you need to ask the bank, what are the terms of the card, and can I use the card and avoid interest by paying the balance off as quickly as possible, okay? And so credit card debt is often the most profitable, the single most profitable product at a bank, okay? And the reason is they typically have pretty sizable balances on them, okay? And even more importantly, the interest rates on credit cards are the highest rates out there. So you need to be very careful when you're using credit cards because the rates are so high, all right? And then banks will also earn discount fees ranging from 1% to 7% of credit card sales from merchants who accept the card. So keep this in mind. When you use your card at a restaurant or at a bank, not a bank, a retailer, the restaurant or the retailer has agreed to pay the bank a certain percentage fee. And they do that because it is easier to get customers to come in. And when was the last time you went to a restaurant and went to pay with a credit card and they said, we don't take credit cards? Okay? So the bank knows that it's important for the retailer, the restaurant or the retailer, to accept cards, and so they extract a fee. So the banks will earn a fee from the retailer and also charge an interest rate on the loan that they make. So it's a very profitable operation. All right. Because of the explosion of credit cards in the last 25, 30 years, there's been a lot of regulation that's come out. And back in 2003, there was a lot of abuse going on, and the credit card companies, the banks, were marketing to people with below average credit, low credit ratings, trying to get these people to run up their balances. Okay? And so Congress jumped in. These people were often charged very high fees, and they were charged very high rates, and they were encouraged to only make low minimum payments. And so these people were taken advantage of. They did not understand what they were doing. And so Congress jumped in because these practices ended up creating significant and severe debt that these people owed and that they couldn't pay back. All right? So in 2009, the CARD Act, the Credit Card Accountability, Responsibility, and Disclosure Act, was passed, and it restricts issuers from raising APRs on their cards. There are a number of dishonest practices that card companies, banks were following, and so laws were written that said, no, you can't do these dishonest things. And if terms are being changed, then customers have to be told that terms are being changed, and the terms that are being changed have to be explained to the customers. Okay? And so the card companies have to post their contracts, their credit card terms, on the internet to make it easy for customers to see what those terms are, and then compare those terms with the terms being offered by other banks. Credit card holders must receive billing statements at least 3 weeks before payments are due, because what was happening was companies were not giving people enough lead time. They were sending bills out, and then they were hitting them with late fees. Okay? Another dishonest practice. Okay? Disclosure must be included on each billing statement that indicated the amount of interest and the consequences of paying just the minimum amount. So these laws were written specifically to address these dirty practices. Okay? Another law that relates to consumer lending, and we've seen it in a lot of different places in this course, the Dodd-Frank Wall Street Reform and Consumer Protection Act, signed into law by Obama in 2010. And one of the things that it did was it created a new agency, the Consumer Financial Protection Bureau. And boy, the banks were screaming about this one when it was created, but it was needed. And it addresses issues like warning consumers of possible damaging financial practices that could result in financial hardship. So this is a counseling. One of the things they do is they counsel with people. What are things that you should do and things that you shouldn't do financially? Promoting financial literacy. Working with the banks to improve the transparency and clarity of contracts so people understand exactly what they're getting themselves into. And this came about because of credit cards, and it also came about because of adjustable rate mortgages that people entered into. And I'm going to check this and make sure that we're rolling. Give you a close-up here. Yes, we're rolling. We're good. All right. All right. So the financial crisis really shook Congress up, and they jumped into action and passed some pretty good laws. All right. So lenders consider two dimensions of consumer loans. One, they are very profitable, okay, and they're profitable because they're priced very high, which means their rates are high. And so market interest rates on deposits and bonds would have to rise very significantly in order to diminish the profit margin. In other words, the spread between the cost or the charge of a loan, a consumer loan, and the cost of funds is very wide. When you compare the spread on a consumer loan with the spread on a commercial loan, the spread on a consumer loan is much higher. Okay? And then interest rates on consumer loans tend to be very sticky. Okay? There's not nearly as much competition, there's not nearly as much negotiation that goes on a consumer loan as there is with a commercial loan. Okay? And so these loans tend to have high rates that don't change very much even when market rates are changing out there in other areas like for commercial loans. So when rates are falling in the marketplace, they tend not to fall on consumer loans. Let me get that right. And so this works in favor of the banks. So when interest rates in general are falling, consumer rates pretty much stay where they are. But banks have to be careful because when interest rates are rising, it's kind of hard to raise the rates because they're already so high on the consumer loans. Okay? All right, so why are interest rates so high on consumer loans? One reason is that consumer lending is very risky. How do we measure that? Well, the default rate on consumer lending is about 2.5%, and the default rate on commercial lending is about 1%. So 250%, or actually 150% increase in the default rate. So that shows you that consumer lending is 1.5 times riskier than commercial or business lending. Okay? The second thing is banks charge high rates because they can. Because the higher rates really don't do anything to dampen demand for consumer lending. And why is that? Because most Americans are more concerned about the amount of the monthly payment than about the interest rate they're being charged. So when you sit down with a customer or consumer and you say, I'm going to charge you 11% on this loan, and they say, man, that sounds really high, you say, well, your monthly payment is going to be $530 a month on 11%. If I charge you 9%, it would be $500 a month. So it's only $30 a month difference. There's not much difference in the payment amount, and you can afford, based on your income, you can afford to make the monthly payment. And so most consumers will accept that. They look at the monthly payment. They really don't look at the interest rate. And the interest rate doesn't have that much impact on individual customers. So as I said in class, if you're looking at a 30-year, $300,000 house loan, then the interest rate is going to be extremely impactful on the payment. But if you're looking at a 5-year, $30,000 car loan, the interest rate isn't going to make any difference at all on the amount of your payment. All right, and lastly, they make the point that the education and income levels that consumers have will really impact their use of credit. And so the less education and the less income that consumers have, then they're going to use very inefficient, high-cost debt to try to take care of their lifestyle. It's kind of a scary thought. Okay. So, again, as with business loans, when you're trying to analyze a consumer loan, you're going to look at the character of the borrower and the borrower's ability to pay. And of course, as the bank gets larger and larger, they're not going to look much at the character. They're just going to look at the ability to pay. All right? So key indicators that banks look at, okay, when analyzing or assessing should they make the consumer loan: the deposit balances that the customer has. They're going to look at tax returns and pay stubs. Then they're going to look at how stable the people are, how long have they been in their employment, and how long have they lived in their home or their apartment. Okay, and the longer the better. Okay, they're going to look at how much existing debt they have, the amount of debt, the cost of their debt, and the structure, meaning when does that debt come due. Okay, so what is the capacity of the customer to pay the loan back? And it's a function of all these things. Okay, so consumer lenders always check with one or more credit bureaus, and a credit bureau is not a government agency, it is a private company, okay? And they check with these private companies that keep up with the customer's credit history. How much debt and how have they paid? Have they paid on time, okay? And so the big three consumer credit bureaus are Equifax, Experian, and TransUnion. All right, so these are companies that get paid by banks to provide data on the credit history of individuals. Okay, and so a borrower without a credit record, so if you have never taken out credit, then you don't have a credit record at these three companies, and so you're an unknown. And so if you don't have a credit record, or if you have a poor record, you may need to have a guarantor, someone who has assets and income and stability and a credit record, who can sign on your behalf and say to the bank, we will step in if this person does not pay. Okay? So the basic theory of credit scoring, which is what these companies do, okay, is that lenders and statisticians can identify financial, economic, and motivational factors that separate good and bad loans. So there is an algorithm that is put into place that will assess the likelihood of someone being able to pay back a loan. Okay? And so the benefit of credit scoring using this algorithm is that it eliminates personal judgment. It takes personal judgment out of it. And the disadvantage is that it eliminates personal judgment. So your friendly neighborhood bank is no longer a friendly neighborhood bank. It is a black box that uses an algorithm to determine whether you get a loan, how much money you will be loaned, and what rate you're going to pay. It's no longer personal, not based on relationships. All right, so the FICO system is the best known credit scoring system out there. It was developed by a company called the Fair Isaac Corporation. That's why it's called FICO. Okay? And so scores, your FICO score ranges from 300 to 850. And the higher your credit score is, then the less risky you are, and the more credit you'll be able to access, and the lower your rate is going to be. Okay? So the FICO score is based on the 5 types of information below, and they are listed in the order of most important to least important. All right, so the borrower's payment history is the single most important thing. So let me tell you this, folks, that when you have an electric bill, you got to pay it on time. When you have a water bill, you got to pay it on time. When you have a car payment, you have to pay it on time. If you have a medical bill, you've got to pay that thing on time. You've got to be careful. There have been times when I've gotten calls from my bank saying, Ellis, your credit score has gone down. And I say, why? And they say, because you have a medical bill. And I check and I find out it's a $30 bill from an